Hi, I'm Kylie Matu. Welcome to Wealthy Millionaire. Today I'm going to talk about mortgage refinancing, closing costs, and what you need to know. First, a disclaimer though, I'm not an agent or a lawyer, and this video is for educational purposes only. Always be sure to consult with a professional before making any financial decisions. Nobody likes to pay closing costs, but you'll likely face them as part of your mortgage refinance, also known as mortgage refinance closing costs. You might want to refinance your home for various reasons, such as tapping into your cash equity, easing financial strain, and lowering your private mortgage insurance costs. However, mortgage refinance fees could cost up to 5% of your principal. It's not an enormous charge, but it'll add up over time. It's important to know what closing costs to expect when refinancing. So what are the typical mortgage refinance costs? You probably remember the closing costs that you paid when you first got your mortgage. Unfortunately, the closing costs on a typical mortgage refinance are very similar. Though there are various expenses and fees that you have to pay when you go through a mortgage refinance, you should compare several lenders to find the lowest rates. You could find a better deal if you do research and compare the market and to avoid mortgage refinance scams. Let's take a look at some of the most common refinance closing costs. First, a loan origination fee. You'll have to pay an origination fee to your lender for processing and preparing your loan. The average origination fee is about 0.5 to 1% of the loan amount. The origination fee essentially covers the customer service provided by the lender. The lender will often stay in touch with you during and after the mortgage refinance process. In addition, the lender will secure your loan, arrange documents, offer verification of the information, and cross-reference any documents if your refinancing application applies to government-backed loans. Nonetheless, you can negotiate all loan origination fees. Don't be afraid to negotiate these costs with your lender because you might save a considerable sum. Can you ask to waive the origination fee on a mortgage? Yes, it's worth a shot, and some lenders may be willing to negate the origination fee altogether. Next is an appraisal fee. You'll get an appraisal before you buy your home for the following reasons: to ensure there are zero hidden problems, and to make sure that you're getting the best deal. You also want to prove the home's value to the lender. You'll also have to get an appraisal when you're looking to refinance the home. Lenders will need to know that the property hasn't changed significantly since you bought it. Appraisers will typically charge around $300 to $600 for an appraisal. The mortgage lender might also need you to complete a pest and termite inspection. They could even require an engineer or a property inspector to access the home's condition. Again, these fees could set you back another $250 to $500. Number 3, mortgage insurance and title fees. When you purchase a home, you'll receive a title. The title is the proof that the seller has transferred the home to you, and the document will prevent you from having any legal issues regarding ownership of the house. You'll need to buy new title insurance when you complete a mortgage refinance. However, many title insurance companies will offer huge discounts for returning customers who already bought policies with the original purchase of the home. Can you get a little insurance credit on refinance? It's possible if you purchased the policy less than 3 years ago. You'll also have to pay for mortgage insurance if you have a government-backed mortgage such as an FHA or a VA loan. Typically, if you've put down a deposit that's 20% of the loan's value, you'll need to pay the private mortgage insurance. This insurance will protect the lender in the case of financial default or any other issues that prevent you from repaying the mortgage. The lender will often offer their own insurance with fees between 0.55 and 2.25%. Number 4, VA funding fee. The Veterans Association has 2 refinance products, the VA Cash Out Refinance and the IRRL. However, the funding for these 2 VA refinance types differs due to the different objectives. The IRRL looks to switch VA homeowners into a fixed rate or adjustable rate VA loan. In contrast, the cash-out refinance options allows veterans to refinance and take cash from the equity of the loan. If you're refinancing a VA loan, you'll have to pay a percentage of the loan to the Department of Veteran Affairs. The amount that you pay depends on the type of refinancing you choose. For example, if it's your first VA loan, the typical funding fee is around 2.3%. That can raise to 3.6% for subsequent loans. And the standard funding fee for the VA IRRL is 0.5%, regardless of prior usage or history. Various people are exempt from the VA funding fee, including anyone receiving VA disability, surviving spouses that receive dependency indemnity compensation. Also, Purple Heart recipients that are on active duty. Some other typical closing costs to watch out for are early repayment fees. It's not uncommon for your lender to charge early repayment fees. However, if you can't get out of this fee, you might want to reconsider a mortgage refinance. Although prepayment penalties don't occur every day, they're often applicable with the first 3 to 5 years of your mortgage. FHA loans and VA loans rarely include repayment fees because they're government-backed loans. There's also discount points. Discount points are interest payments on your mortgage's total amount. Lenders sometimes charge points when you complete a mortgage refinance in order to make more profit. You should try to negotiate these fees with your lender, and if you can't avoid them, try to calculate how much they'll cost you to see if refinancing is still worthwhile. You can use a mortgage discount points calculator to help you. Then there's a credit report fee. Lenders will need to ensure that your credit score hasn't dropped since you got the loan. Lenders will need to conduct a new credit check, and then they'll likely charge a closing fee for that. Credit reports cost between $25 to $50. There's also higher loan balances. When you decide to roll in the closing costs, your loan's total balance will increase. Although it might not be a considerable sum on the surface, it will add to your monthly repayments. So make sure you're confident that you can repay a higher loan balance if you choose to roll in your closing costs. Facing closing costs can be frustrating for any borrower. You should ensure that you can afford to cover all closing costs. If not, you should consider whether a mortgage refinance is the best option for you. Alternatively, you can get a no closing cost refinance. However, while these refinance options have no upfront fees, they often make up for it by rolling closing costs into your loan or charging higher rates. When refinancing your home, make sure you negotiate with the lender, conduct thorough research, and understand the mortgage refinance costs. If you do all of that, your mortgage refinance will be a seamless process. Let's take a look at some frequently asked questions. Why does refinancing cost so much? Typically, closing costs can range from 2 to 5% of the loan amount. This also includes lender fees and third-party fees. Refinancing involves taking out a new loan to replace your old one, which means you'll repay many mortgage-related fees, which include the Loan Origination Fee, appraiser's fees, credit report fees, application fee, and attorney fees. Next question, is it cheaper to refinance with your current lender? This depends. Sometimes it's cheaper to refinance with your current lender, as your current lender might reduce the cost of certain services or waive select fees to keep you a customer. However, you should always shop around and compare costs, rates, and terms. Third question, can closing costs be included in a refinance loan? Some lenders sometimes allow borrowers to roll closing costs into their new mortgage loan. However, keep in mind that rolling closing costs into your new loan will result in an increase in the total loan amount. This is an option only when the homeowner has enough home equity to back a larger loan amount. Fourth question, is a credit check required when you refinance? Lenders will check a borrower's credit score and credit report to ensure they meet the minimum credit requirements for a loan. I hope you enjoyed this session on mortgage refinance closing costs and what you need to know. I'm Kylie Mattu. Thank you for watching Wealthy Millionaire. And remember, the more you save, the more you earn.